Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me to discuss the impact of COVID-19 on the economy, gambling, hospitality, and real estate sectors is Jason Ader. He's the CEO of SpringOwl Asset Management. Jason, welcome to Trade Talks. It's great to have you with us.
Hi, Jill. Good to be here. How are you?
We are doing great, and we have a lot of good topics to cover this afternoon. So let's review the current economic climate with COVID-19 as the backdrop, because certainly no one expected this would be our new normal at the end of 2019 when analysts were delivering their 2020 outlooks.
That's for sure. Hard to believe when you walk around New York and all you see is empty hotels and restaurants that are probably never going to open. That was not in anyone's forecasts.
That's for sure. And our home studio is in Times Square, New York, and I never thought in a million years I'd be doing it in my kitchen with 3 cats around me, but here we are. So we have to deal with the economic cards that have been dealt. And let's talk about travel and leisure. They're the obvious sectors that took a massive hit as a result of the COVID-19 lockdown. So what's your outlook on the other side of COVID-19?
Well, I think it's going to be a very tough and very slow recovery, Jill. I mean, if you think about it, people who are working now remotely are getting used to it. Some even like it. But the business travel is not likely to come back anytime soon. I mean, I think we all want to go elsewhere beyond the short radius of our homes, but really the need to travel for business meetings, for sales meetings, for conventions, special events. It's just hard to see that coming back for at least 60 months. And I like to use that 60-month period because that's about what it took Las Vegas to recover after 9/11 to get back to a more normalized level. This is kind of like a 9/11. I mean, it's different. You know, they always say history doesn't repeat, it rhymes. So we're rhyming a bit with real tough crisis in 9/11. But in about 5 years, we might be back to where we were, but it's going to be a very rocky road between now and then.
Yeah, and 2 other sectors that certainly got hit. You have commercial and you have residential real estate trends that were kind of in play prior to COVID-19, but it seems that they've certainly been accelerated. What are your thoughts with the sector as we move to the other side? I think commercial is going to have just as much of an issue as you said with business travel. Those are the tenants that would be filling these commercial spaces.
I think commercial real estate prices have nowhere to go but down, and the question is how much. I mean, it's every company I know is looking to downsize space needs, and when I say commercial, in addition to that, I mean retail too, because the retailers are all moving online. Just have fixed space in the major cities is just becoming less and less economic. So those businesses, the REITs that hold assets in commercial and retail, I think will be very challenged. Now, residential is a slightly different story. You do have a migration out of urban markets into rural markets. So you take great areas around greater population centers like New York, you do see a surge in pricing in Hudson Valley in Connecticut and Westchester and New Jersey, Hamptons. These are big. I saw a 13-year high for Hamptons prices. So and New York City, you could get the deal of a lifetime if you were interested in buying.
Yeah.
So I think the residential market from that perspective is also being affected by tax changes. And we just continue to see migration out of New York, California to Nevada, Texas, Florida. And so I don't see a significant overall national decline in real estate prices. I think certain urban markets like New York are in a very difficult spot, but the suburban markets, the low tax states like Florida, Texas, Nevada, I think are extraordinarily well positioned.
Well, also the difference is, because I was going to ask you, it's almost like 9/11, you could get fantastic deals downtown, and it did eventually recover. I mean, look at where we were just in the fourth quarter of 2019 and the prices in the city. But what's different this time around is people are recognizing that they can work from home, be far more productive, spend a fraction of what they were paying in a larger home with a yard than having to live in New York, because we don't have the tax advantages anymore. I mean, that has been cut significantly over the past couple of years. So that acceleration of COVID-19 to get people out of the city certainly helped, but we don't have to go back to work. We can work from home. We don't have to be in the city. So I think that could lend to the challenge with residential real estate we did not have in 9/11.
That's right. I think it's going to be very tough, but I was also quite negative on downtown after 9/11. And I have a friend, I'll just call him by the name of Scott. And Scott told me, now's the time to be buying downtown real estate. And it was one of the boldest calls I think I've ever seen in my career. And he made an absolute fortune post 9/11, buying up everything he could in downtown. So I called him recently. I was on the phone with Scott and I said, so what are you doing about New York? I mean, I see all these empty buildings and I see that hotels say they're closing for good. What do you think he said? I'm buying. So
Yeah.
I thought that was, I mean, it's such a great call, and it was so counterintuitive right after 9/11. He couldn't have been more aggressive, and he's taking quite an aggressive approach today. There's he's got his pick of deals.
Yeah, it certainly does. It's going to be interesting to see how real estate plays out. And just to go back to commercial for a minute, I also think investors are really focused on the carbon footprint as well, too, because ESG is not just a trend, but it's something that is certainly here long term. It's not going anywhere. But we saw what happened on the data maps when no one was flying. I mean, we could see it in our atmosphere, just in our backyards, how the lack of pollution really makes a big difference. So I think you also have to worry about carbon footprint. And if you don't need to make it any bigger than it has to be, there really isn't that need for that travel or to have people come back into the cities.
It's very true. Certain people are certainly being much more sensitive to ESG and the impact that their business has on the environment. But the bigger issue is how this pandemic has affected the need to travel and people's comfort with working on a remote basis, and how spacing has just been reconfigured in the office environment for the foreseeable future. And a crisis like this creates absolute winners. And Amazon is probably top of the list. I mean, how many Amazon packages do we all get a day? At the bottom, you find, certain areas of real estate, like office space in New York, that just have a very, very hard time recovering. Hotels too. It's no V shape in my crystal ball for the hotel industry.
Yeah, well, I'm for one helping to contribute to Amazon's bottom line. Jason, it was great to have you with us. Thanks for joining me on Trade Talk.
Yeah, great to see you. Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.